How much money do you think you need to retire? 1 million, 2 million, maybe 5? Most people answer this question with a random number, usually based on what they've heard online, flashy headlines, or unrealistic success stories. But here's the uncomfortable truth. That number, by itself, means absolutely nothing. Every day, smart people work hard, save, invest, and still have no idea whether they're actually on track for a secure retirement. Not because they lack effort, but because they lack clarity. They chase a magic number, believing that once they reach it, all financial problems will simply disappear. But the problem is that retirement doesn't work that way. The right question isn't, how much money do I need to save, but rather, how much income do I need to generate every month to support the life I want? When you change that question, everything changes. The final number, the strategy, the level of risk, and even the way you view investing. In this video, you'll learn how to actually calculate how much you need to retire using index funds in a practical, rational, and data-driven way. No unrealistic promises, no magical shortcuts. This is the same mindset used by long-term investors who turn simplicity and consistency into financial freedom. And to understand why so many people get it wrong right from the start, we need to talk about the most common mistake of all, the one that makes people focus on millions when they should be focusing on income. When it comes to retirement, most people make the exact same mistake. They turn everything into a big, abstract number, 1 million, 2 million, 5 million. These numbers sound impressive, but they're rarely connected to the reality of the life someone actually plans to live. The problem with thinking this way is that net worth by itself doesn't pay the bills. What sustains your retirement isn't the total amount invested, but the monthly income that portfolio can generate sustainably. Without that clarity, you can accumulate a lot of money and still be afraid to spend it, or worse, spend too much too fast and run out. Imagine two people. The first accumulates $2 million, but needs $10,000 a month to maintain their lifestyle. The second has half that amount, but lives comfortably for $4,000 a month. Who is really more financially secure? The answer almost always surprises people who only think in big numbers. This mistake happens because we've been conditioned to think of retirement as a distant, almost abstract destination, rather than as an income system that works month after month. When you ignore that difference, you end up investing without a strategy, without knowing whether you're moving forward or just spinning in circles. That's why before talking about index funds, withdrawal rules, or simulations, it's essential to redefine what retirement actually means. Because depending on the definition you use, the path and the amount you need changes completely. And that's exactly what we need to clarify now. When someone says, "I want to retire," that phrase can mean completely different things. For some people, retiring simply means stopping work. For others, it means living entirely off investment income. And for a smaller group, it means having total freedom to choose whether to work or not without financial pressure. This difference isn't just conceptual, it completely changes the number you need to reach. If your goal is simply to stop working as soon as possible, you might accept a simpler lifestyle and lead less monthly income. But if you want to maintain or even improve your current lifestyle, you'll need a larger portfolio generating consistent income. Financial freedom, on the other hand, requires an even bigger margin of safety because it's about choices, not obligations. The common mistake is never stopping to define this clearly. Without that definition, any retirement calculation becomes a guess. You might be investing too much, sacrificing quality of life today, or investing too little, creating a false sense of security. Retirement, at the end of the day, isn't about age, it's about financial autonomy. It's the moment when your money starts working more for you than you work for it. And if the foundation of your retirement needs to be predictable, efficient, and long-term, the tool you choose makes all the difference. That's why in recent years, one specific type of investment has become the backbone of modern retirement. When we talk about long-term retirement, the most common mistake is believing that you need to predict the market, pick winning stocks, or build complex strategies. In practice, the simpler and more predictable the plan, the greater the chances it will work for decades. When it comes to how much you need to retire, the most important variable is not investment returns or the type of fund you choose. It's something much simpler and often ignored: how much you spend to live. Retirement isn't about how much you earn today, but about how much you need to spend every month to maintain the lifestyle you consider acceptable. Two people with the same income can need completely different amounts to retire, simply because they have different lifestyles. Think about it this way: every real, dollar, or euro you spend each month needs to be replaced by investment income in the future. If you spend $4,000 a month, your portfolio needs to generate $4,000 consistently. If you spend $6,000, that number automatically goes up. There's no escaping this math. This is where many people get frustrated. They try to increase returns, take on more risk, or look for shortcuts, when in reality, the biggest impact comes from consciously controlling your cost of living. Small decisions, living in a more expensive place, changing cars frequently, inflating your consumption standards, can double or even triple the amount of wealth you need to retire. This doesn't mean living in deprivation, but living with intention. The more aligned your lifestyle is with your values, the less pressure there will be on your investments in the future. Now that you understand that expenses define the final number, the inevitable question arises: how do you turn that monthly spending into a total net worth number? For that, there's a very well-known and very misunderstood rule that we need to examine carefully. That's exactly why index funds have become the foundation of modern retirement. Index funds don't try to beat the market, they replicate the market. By investing in them, you become the owner of small pieces of hundreds or even thousands of companies at the same time. This drastically reduces the risk of individual bad decisions and eliminates the need to constantly guess which asset will go up or down in the short term. Another crucial point is cost. High fees quietly erode your retirement over the years. Because index funds are passive, they have much lower costs, and over the long term, that difference can represent hundreds of thousands of dollars more in your final portfolio. On top of that, they encourage the right behavior. Since they don't require constant trading, they help investors maintain discipline, consistency, and a long-term focus, exactly what a successful retirement requires. But choosing the right tool is only part of the equation. Even the best investment in the world solves nothing if you don't know how much income you need to generate. And to figure that out, we need to look at something much closer to your reality than the financial markets: your current lifestyle. Once you understand that your lifestyle defines how much income you need, the next natural step is to try to convert that monthly number into a total net worth number. That's when almost everyone runs into the so-called 4% rule. Simply put, this rule suggests that you can withdraw about 4% of your invested portfolio per year, adjusted for inflation, with a good probability of not running out of money over time. In other words, if you need $48,000 per year to live, you would need roughly $1.2 million invested. The popularity of this rule comes from its simplicity. It turns a complex question into a straightforward, easy-to-understand calculation. But here's the critical point: the 4% rule is a guideline, not a guarantee. It was created based on specific historical data in a specific country during specific market periods. That means it works better in some scenarios and worse in others. Long periods of high inflation, low returns, or extended crises can put significant pressure on that percentage. In addition, the rule doesn't account for real human behavior. In practice, people don't withdraw the exact same amount every year, nor do they react neutrally to market downturns. Emotional decisions during bad periods can undermine the entire plan. That's why the biggest mistake isn't using the 4% rule, but using it blindly. It should serve as a starting point, an initial benchmark for estimates, never as an absolute promise. And to truly understand the real-life impact of this rule, nothing is more powerful than moving beyond theory and looking at concrete numbers. That's exactly what we're going to do now, with real simulations based on different spending levels. Up to this point, we've talked about concepts, rules, and principles. Now it's time to turn all of that into real numbers, because it's only when you see the figures concretely that retirement stops feeling distant and starts to make sense. Let's begin with a simple scenario. Imagine someone who spends $2,000 per month to live comfortably. That's $24,000 per year. Using the 4% rule as a reference, this person would need approximately $600,000 invested to generate that income sustainably. For many people, this number already feels more attainable than the millions that often appear on social media. Now let's raise the lifestyle a bit. Someone who spends $4,000 per month needs $48,000 per year. Applying the same logic, the required portfolio increases to around $1.2 million. Notice that doubling your cost of living doesn't just double your comfort, it also doubles the capital required. Finally, consider someone who wants to spend $6,000 per month in retirement. That's $72,000 per year. In this case, the required portfolio approaches $1.8 million. Here, it becomes clear how seemingly small lifestyle decisions can have a massive impact on the final number. These examples highlight something fundamental. It's not the market that determines how much you need to retire, it's your spending habits. The higher your monthly expenses, the greater your dependence on a large portfolio, and the greater the emotional pressure during market downturns. These simulations aren't meant to scare you, but to bring clarity. When you understand your number, you can build a realistic plan, adjust expectations, and make more conscious decisions today. And once that number is clear, the next inevitable question arises: how much monthly effort is required to get there? The answer depends on a factor most people underestimate, and one that can work either for or against you: time. When people run retirement calculations, they tend to focus only on the final number, but what really determines how difficult or achievable that goal will be is the amount of time you allow your money to work for you. Compound interest works in a simple way. You don't just earn returns on what you invest, but also on the returns that accumulate over the years. At first, this growth looks slow, almost insignificant. That's exactly why many people give up too early. But over time, the effect is exponential. Imagine two people with the same financial goal. The first starts investing early, even with modest contributions. The second delays the decision for a few years and tries to make up for it later by investing larger amounts. In most scenarios, the person who started earlier ends up with more money, even though they invested less over their lifetime. Time reduces the required monthly effort. The earlier you start, the smaller your contribution needs to be to reach the same final portfolio. On the other hand, the longer you wait, the greater the pressure on your future income, and the higher the risk of frustration and abandoning the plan. This doesn't mean that starting late condemns you to failure. It simply means your choices need to be more realistic and disciplined. The mistake is ignoring the time factor and trying to solve everything with higher returns or riskier strategies. After understanding the power of compound interest, many people believe that all they have to do is invest and wait. But reality is a bit more complex. Even with good investments and plenty of time, there are risks that can undermine your retirement if they're not considered from the very beginning. Even with a solid plan, consistent investing, and time on your side, retirement is not a path free of obstacles. There are real risks that, if ignored, can compromise years of effort, and most people only realize this when it's already too late. The first major risk is inflation. It silently and constantly erodes purchasing power. An amount that seems sufficient today can become inadequate in just a few years if your investments don't keep up. That's why thinking about future income without accounting for inflation creates a false sense of security. Another important risk is market downturns, especially early in retirement. A sequence of negative returns right after you start withdrawing can cause significant damage to your portfolio, even if the market recovers later. This is a rarely discussed risk, but an extremely important one for anyone living off income investments. There's also the risk of human behavior. During market declines, many people sell at the worst possible moment out of fear, locking in losses that could have been temporary. Others do the opposite. They withdraw too much when markets are strong, believing the good times will last forever.
And finally, there's the risk of over-withdrawing. Consistently spending more than planned can dramatically accelerate the depletion of your portfolio, making a retirement that looked solid on paper unsustainable. Recognizing these risks is not a reason to give up, but a reason to prepare better. And the best way to reduce all of them is to have a clear, conservative plan aligned with reality. That brings us to the most practical question of all. How much do you need to invest each month consistently to reach your numbers safely?
After understanding how much you need to accumulate and which risks must be considered, we arrive at the most practical part of the entire plan: how much to invest each month to turn that goal into reality. This is where many people are surprised, because the monthly amount is often more affordable than they imagined, as long as there's time and consistency. Let's work with 3 different time horizons. For someone who wants to retire in 30 years, monthly contributions can be relatively moderate. With realistic long-term returns, small amounts invested consistently have enough time to grow and compound. In this scenario, time is the main ally. For those with a 25-year horizon, the effort increases slightly but remains achievable for most people who adjust priorities and stay disciplined. Here, consistency becomes even more important than trying to accelerate results with risky strategies. With a 20-year horizon, the challenge is greater. Contributions need to be higher, and any interruption in the plan has a significant impact. This doesn't make the goal impossible, but it does require more commitment, less improvisation, and expectations that are well aligned with reality. The most common mistake is trying to start with high contributions and abandoning the plan a few months later. Retirement isn't won by intensity, but by consistency. A smaller amount invested every month almost always beats large, sporadic contributions. In the end, the ideal plan is the one you can sustain over the years, even during difficult periods. And when you understand this, it becomes clear that retirement doesn't depend on complex formulas, but on something much simpler and much harder to maintain: behavior over time. After going through numbers, rules, simulations, and risks, it becomes clear that retirement doesn't fail because of a lack of information. Most of the time, it fails because of a lack of consistent behavior over time. Index funds work because they are simple enough to allow discipline. They reduce the need for constant decisions, minimize emotional mistakes, and reward those who can stick to the plan even when the market fluctuates. The truth is that 2 people with the same income, the same investments, and the same returns can end up with completely different results. The difference is almost never in the math, but in the ability to follow the plan for decades without abandoning the strategy during tough times. Retirement is a patience game. Those who try to be brilliant usually lose. Those who are consistent usually win. And it's exactly this mindset that connects everything we've covered so far and prepares the ground for the most important decision of all: taking the first conscious step starting today. Retirement doesn't begin in the future. It begins with the decisions you make today, even if they seem small. Clarity, consistency, and simplicity beat any complicated strategy over time. If this video helped you see retirement in a more realistic way, like the video, subscribe to the channel, and comment, how many years do you plan to retire in? The journey to financial freedom begins with a plan, and now you have yours.